Yeah, well, I think you hit it. We got to a resistance level. It was a really natural resistance level. Coincided with a 65-day high, which took us back into the fall. Coincided with a declining 200-day moving average. We had no thrust. We didn't have anything from the measures that we look at that give us some indication of escape velocity, and we really stalled out right there. And we actually did it on what I would consider, more bullish news for the market, with sort of this affirmation that inflation has probably peaked, and yet we still couldn't get through it. So I think that sets up bearishly for the first quarter of 2023. I'm hopeful that we can hold the lows because we did have some, pretty good sentiment figures and washout type of behavior. But I think this is just a elongated purgatory almost for equity investors right here as we get through this readjustment period.
Yeah, it obviously has been kind of nobody happy with it. Even if you're bearish, it's been kind of tough to catch the straight line moves. They've been pretty quick. What is the macro message that you might pull out of what the market is suggesting here, with things like parts of industrials doing well and even discretionary not falling apart? Is that are those head fakes, or are they something you would like to get behind?
Well, I think it's a good question, and I'm really not sure. But I would say they're incrementally more bullish than not. I mean, discretionary is really important because when we go back and look at bull markets, discretionary participates in every bull market in some way, shape, or form. It doesn't have to be the leader, but it certainly is, a top three, if you will. And it hasn't achieved that status here, but home builders look good. Apparel names are looking better. What we're seeing out of the casinos starting to look better. The restaurants. So I think that, along with some of these industrials, really suggests that any type of recession, even if we have a recession, is probably a soft landing and possibly not even a recession, just an incremental change in the growth dynamics, which were so powerful a year ago. That feels maybe like a recession to equities, but ends up, really just ends up being something that's contracted growth from the excessive levels that we had in 2021.
Yeah, it's been such an interesting compressed cycle, maybe just a stutter step, and we're over anticipating a deeper downturn. Got to see about that. But when it comes to the very largest index names, I know that's been a pretty persistent source of pressure on the markets, and a lot of them look like it's kind of a long-term trend change. You pointed out today, Apple just sort of structurally looks like maybe it's topping. How does that set up right now?
Well, it's bearish. I mean, if you're into pattern recognition, which it's not really our forte, but we certainly pay attention to it. You're talking about a head and shoulder top formation that really counts to about 100 down on the objective to the downside. In fact, you can get under that if you really lean into it. You can get to about 85. So I think there's additional pressure there, and the reason that's important, one, it's obviously a mega cap tech name that has huge influence on the index, but it's also within technology, and it has been one of the leaders of technology, really the last one to break, if you will, in terms of the trend. Now, that might be good news because it says we're starting to get to everything, but I think there's more downside there for Apple before there is some type of a low or a bottom, and I think it's something that will probably continue to put persistent pressure on the overall index just because of the size of the constituent.
Yeah, I mean, I know that this has been something that has really struck a lot of these big names. In other words, it seems like there's individual company stuff happening, and there is always, but yet they all kind of went up as a group, and they're showing similar underperformance recently. Does that lead you to that idea that just, you might as well stay away from the largest names, or go with an equal weighted approach to the indexes, or just keep it into particular pockets of strength?
Well, we like to go for pockets of strength, but as a second consolation prize, I would go equal weight because I think there is more interest in better charts along with the breadth. But back to the point on industrials and what we're seeing out of the discretionary names, and what we're seeing out of some of the select areas in energy, even some of the steel names in materials still look really, really good to us. So I think this is a market where we can almost perfectly show you a very good sub-industry group within a sector, and within that same sector, autos as an example, within discretionary, we see something that's terrible and looks like there's further downside, and that's true really across the board, whether it's in REITs, whether it's in staples, discretionary industrials. I can show you very, very bullish long-term charts, and I can show you very, very bearish long-term charts. And I think that's great news for our clients and active investors that are not just indexing, because I think you can add value here, but it does get frustrating in terms of trying to isolate and pull out or distill a message from the overall market.
Yeah, a little tougher for those of us who have to, tell a story about it, but that's okay. Jeff, great to talk to you. Appreciate it. Enjoy the holidays.